Car manufacturers are already previewing their 2026 vehicle lineup. Some shoppers say President Trump's tariffs are giving them some pause. Industry experts warn even if you're not buying a car yourself, expect to pay up.
People are tired. If you feel like every time you walk past a dealership, the prices just look more and more out of reach, you are not alone. The funny part is, from the outside, it seems like dealers should be swimming in money. Prices are still high, lots are full again, and you see brand new models everywhere. But once you actually look under the hood of what is going on, the story is very different. What we are seeing right now is a strange mix. Buyers burned out on high payments, banks tightening up, and dealerships quietly struggling even while they are surrounded by vehicles. In this video, I want to walk you through how we got here, what has changed, and what it means if you are thinking about buying your next car. How we got here. To really understand why people are so worn out with car shopping, we need to back up a little. Not too far, just enough to see that we have lived through three very different markets in a short amount of time. First, think back to the years before the year 2020. The car market was not exactly cheap, but it was predictable. You walked into a dealership and you expected some kind of discount. Negotiating was normal. Manufacturers' suggested retail price was a starting point, not the final price. Dealers would often sell new vehicles with almost no profit on the front end. They made much of their real money in the finance and insurance office, through service contracts, add-ons, and of course through the service department over time. It was not glamorous, but it was stable. Then everything flipped. When the global health situation hit around the year 2020, we went into what felt like a parallel universe for car prices. Factories slowed down or stopped. Supply chains got messy. Microchip shortages meant fewer vehicles were being built. The result was simple. Lots were empty, but demand stayed strong. People needed cars for work, for family, or they wanted to take advantage of very low interest rates while they still could. That second era, from roughly 2020 to around 2022, was the shortage boom. Dealers suddenly had all the power. If a truck or a sport utility vehicle hit the lot, it was gone the same day. Discounts disappeared. Manufacturers' suggested retail price became the floor. People paid thousands of dollars above sticker. Dealers added market adjustment stickers that were basically just extra profit. Some buyers were even flipping vehicles, buying new and selling them used for more than they paid. Now we are in the hangover phase, the third era. Inventory is back. Lots that were once empty now look stuffed. You can actually find a specific trim level again. Discounts have quietly returned on many models. But here is the catch. Those high sticker prices from the shortage years never really came back down. Combine that with higher interest rates and stricter lending, and you get a very tired buyer who has seen too much. And the fatigue is showing up in all kinds of ways, from the person staring at their monthly payment calculator at home to the salesperson standing on a full lot watching people walk away. Pause for a second and tell me, are payments killing deals in your area? Share your situation in the comments. Sticker shock. Let us talk about what you actually see when you walk the lot now, because that is where the frustration really kicks in. When a so-called normal vehicle starts to look like a high-end luxury purchase, that is when people mentally check out. Take a Jeep Wrangler with the big V8 engine, the Rubicon 392 version. This is a Jeep. It is rugged, fun, loud, and in some trims it is pushing close to luxury car money. You will see prices in the high $80,000 range, sometimes more when they were brand new. That is a number people expect on a serious German luxury sedan, not on what started life as a basic off-road box on wheels. Then you look across the lot, and you see an actual luxury car, like a 2024 BMW 7 Series sedan with relatively low mileage, priced in the mid-$80,000 range. So now you have this strange moment. A fully loaded Jeep Wrangler and a prestige German full-size sedan are basically in the same price neighborhood. For many buyers, that does not feel right, even if the vehicles target different customers. It is not just big sport utility vehicles. Compact crossovers and small cars have crept up, too. A simple, practical crossover like a late-model Honda HR-V can easily sit in the high $20,000 range. A performance-oriented Toyota Corolla, the kind that is aimed at enthusiasts, can climb deep into the $40,000 range. We are talking about a compact Toyota hatchback, priced like an entry luxury car from a decade ago. Then you move into the used section, where it used to be safe. Used cars were traditionally the budget escape hatch. But even there, People are seeing older vehicles with normal mileage carrying prices that would have sounded crazy not long ago. A mid-2010 model year compact sedan with around 60,000 miles, still asking high teens or more. The message customers are getting is simple. No matter where you look, everything feels expensive. New is expensive. Used is expensive. Trucks, crossovers, sports cars, even basic transportation. At some point, buyers just say, I am tired of this. I will keep what I have. And that is exactly where things start to break down for dealerships, especially when the old rules about manufacturer-suggested retail price and discounts have quietly flipped again without most people really trusting that shift yet. From markups to discounts. During the shortage years, dealers got used to something that felt almost unreal. Vehicles arrived, and they basically sold themselves. A new model Corvette? People would pay $20,000 over manufacturer-suggested retail price without blinking, as long as they could be the one to get it. A full-size truck or a popular sport utility vehicle. Sticker plus an extra few $1,000s for market conditions. It was not subtle. Now, that same Corvette tells a completely different story. Instead of sitting at $20,000 above manufacturer-suggested retail price, many are now sitting $10,000 to $15,000 under that manufacturer-suggested retail price, especially when you look at lightly used examples. You can see a nearly new Corvette with extremely low miles being offered for less than a brand new one. And on top of that, some buyers can negotiate discounts on fresh cars that have just arrived. This is not just about one sports car. It is a symbol of the whole shift. During the boom, front-end gross profit, meaning the money made just on the sale price before finance and insurance, went to levels most managers had never seen in their careers. Now, that front-end profit has been squeezed hard. To move units, discounts are back, manufacturer incentives are back, and the market adjustment stickers have quietly disappeared on many models. The strange part is, most customers do not really feel like prices have gone down, because they have not, in an absolute sense. The manufacturer's suggested retail price stayed high, and now instead of paying above it, you are maybe getting a few $1,000s off. From the buyer's perspective, it still feels like they are staring at a huge number and arguing over what amounts to a small slice. This is where fatigue builds. People heard friends brag about making money on their cars during 2021. They saw news about crazy markups. They saw empty lots. Now, when they finally think, maybe it is my turn to buy, they do not see the deal they imagined. They see big window stickers, regular depreciation, and monthly payments that stretch their budget. They missed the flip a car and profit window, but they are stuck with the leftovers in pricing. And this would be frustrating enough on its own, but once you mix in what has happened with interest rates and lender rules, it goes from annoying to exhausting for a lot of shoppers. Financing squeeze. If you talk to salespeople or finance managers right now, they will tell you that getting a deal approved can be more challenging than actually finding the right car. The vehicle might be perfect, the customer might be excited, but the numbers on the loan application turn the whole thing into a waiting game or a rejection. Lenders have become more cautious. During the boom, when used vehicles were holding their value unusually well and demand was through the roof, everybody was a little more relaxed. Now that prices are high, depreciation is back to normal, and some buyers are stretched thin, banks and finance companies are paying closer attention. That means more documentation, proof of income, proof of residence, careful verification of job history. It also means more deals where the bank says, we want more money down, or we will only approve this if the price comes down, or the interest rate needs to be higher to cover the risk. The split between buyers with strong credit and buyers with weaker credit has widened. If you have excellent credit, a stable job, and a solid history, you can still walk into almost any dealership, pick from a wide selection, and get approved quickly at a reasonable rate. You might even have multiple lenders competing for your loan. But if your credit is bruised, or you have had late payments, things look very different. You might be staring at interest rates well into the 20% range on a used compact car. You might see a modestly priced vehicle turning into a payment that looks more like a luxury car lease because of the rate and the term length. For many people in that situation, the bank is effectively saying, you can buy, but only if you are willing to live with this heavy payment. And a lot of them simply cannot. That is where deals fall apart. The customer wants the vehicle, the salesperson wants to help, the manager wants to make the numbers work, but the lender is not comfortable with the risk unless conditions are met that the buyer cannot afford. Maybe it is $3,000 or $4,000 down. Maybe it is $5,000 down. For someone already struggling, that might as well be $50,000. So, on one side, you have high prices and normal depreciation. On the other side, you have tighter lending and higher interest. In the middle, you have buyers who open the payment calculator on their phone, type in the numbers, and decide to walk away. That decision does not just affect them. It rolls downhill to the dealerships in ways that are starting to show up behind the scenes. Dealerships behind the scenes. From the sidewalk, a full lot can look like a sign of strength. Rows of shiny new sport utility vehicles, trucks, sedans, and crossovers lined up under the lights, plus a healthy used section. To someone driving by, it might even feel like dealerships are still making a killing. But when you talk to people inside the business, you hear a different tone. Dealerships are facing a strange combination. More inventory than they had during the shortage years, but less profit per vehicle and a customer base that is more hesitant to commit. Volume in terms of unit sales can be higher than it was in 2021, simply because there are more vehicles available, yet the gross profit per vehicle is often much lower than in the boom. This means that, in order to hit the same revenue targets, stores need to sell a lot more cars. But each deal takes more work, more time with the lender, more effort explaining payments, more customers who have to go home and think about it, because the monthly number does not feel safe. On top of that, those stores that rely heavily on buyers with weaker credit are in a tougher spot. When approvals get harder, they are the first to feel the slowdown. They might still get a large number of leads, but turning those leads into funded deals becomes a challenge. We have already seen large used car-focused companies reporting higher delinquencies and losses on auto loans they arranged during the hot years. When too many buyers cannot keep up with payments, it eventually feeds back into how much risk lenders are willing to take in the future. There is also the cost of holding all that inventory. Vehicles sitting on the lot are not just parked. They are financed by the dealership, insured, maintained, and watched as they slowly age. As months go by, the pressure to discount grows. Managers have to choose between protecting the gross profit and keeping the turns high enough that the floor plan costs do not eat them alive. Add all of this together, and you get something that sounds odd at first. A market where customers feel like everything is overpriced and dealers feel like they are not making enough money. Both sides are tired, but for different reasons. The buyer is sick of the sticker and the payment. The dealer is sick of the grind to make thin deals work. That tension is shaping the experience you have when you walk into a showroom right now. And if you are thinking about buying in this environment, it helps to understand how to position yourself so that fatigue works in your favor instead of against you. What this means if you are shopping now. So let us bring this down to your level, to the person who might need a car in the next year or two. Maybe your current vehicle is starting to get unreliable. Maybe your family is growing. Maybe you simply want something newer and safer. How do you deal with a market where buyers are tired, dealers are squeezed, and banks are cautious? If you have strong credit, this might quietly be one of the better moments you have had in a while, even if it does not feel like a deal era on the surface. Inventory is mostly back. Discounts and manufacturer incentives exist again, especially on slower moving models. Many dealers are motivated to move units, as long as the numbers still make sense. For you, the key is not to rush. Shop around. Get pre-approved with your own bank or credit union so you have a baseline interest rate. Then compare what the dealer's lenders can offer. Look at the total cost, not just the monthly payment. If a vehicle is sitting on the lot with a high sticker, do not be afraid to ask directly what kind of discount or rebate programs are available. In a tired market, polite but firm negotiation is back on the table. If your credit is weaker, the strategy looks different. The hard truth is that the interest rate can crush you faster than the sticker price. One of the most powerful things you can do is focus your energy on improving your credit and building a realistic down payment before you even step foot on the lot. Paying down small debts, making every payment on time for a stretch, and having a few $1,000s ready can change the conversation with the lender. It might also mean adjusting expectations for a while. Instead of reaching for the fully loaded sport utility vehicle or the top trim sport compact, you might be better off with a reliable, simpler sedan or base model that keeps the payment manageable even at a higher rate. That is not as exciting, but in a market like this, survival sometimes beats excitement. No matter what your credit looks like, going in with clear boundaries will protect you from fatigue turning into regret. Decide your maximum monthly payment before you talk to anyone. Decide how long you are willing to stretch a loan term. Decide whether you are okay paying close to manufacturer-suggested retail price if the interest rate and terms are strong, or if you would rather push harder for a discount. The car market right now rewards the buyer who is patient, informed, and willing to walk away if the numbers do not feel right. That is the quiet power you have in a time when everyone else is tired. And as this dynamic continues, we may see some interesting shifts in how dealers operate, how manufacturers price vehicles, and how lenders manage risk. The new normal. To put it simply, the shortage era is over, but the price hangover is still here. Buyers have seen too much. They watched vehicles sell for way above sticker. They heard stories of people flipping cars. Now they stand in front of a window sticker and feel like the joke is on them. Dealers, on the other hand, are dealing with full lots, thin margins, and lenders that are no longer as generous as they once were. They are still selling cars, often more units than in the peak shortage years, but they are working harder for less profit per deal. The easy days of take it or leave it, here is the market adjustment, are gone. Where this all goes next is not fully clear. Maybe manufacturers will eventually be forced to rethink how high they let prices climb. Maybe we will see more aggressive incentives, more leasing offers, or new kinds of financing structures. Or maybe the market just grinds along like this for a while, with tired buyers and tired dealerships slowly adjusting to each other. For now, if you are in the market, your best move is to stay calm. Do your homework, and remember that you do not have to buy the first thing you see. There will be other cars. There will be other deals. Let me know what you are seeing in your area, what prices look like on your local lots, and how your experience with the banks has been. If this helped you make sense of what's going on in today's car market, let's keep the conversation going. Drop a comment and tell me what prices and payments look like in your area, or share your recent dealership experience. If you found this breakdown useful, hit like so more people can see it. And don't forget to subscribe for more real-world car market updates and practical buying strategies.